Ladies and gentlemen, welcome to our investing podcast. Our guest today is Meb Faber, the co-founder and chief investment officer of Cambria Investment Management. He also runs the YouTube channel The Meb Faber Show, where he hosts a weekly podcast. Meb has also written several books on investment matters, such as Global Asset Allocation and Global Value, as well as well-documented articles like A Quantitative Approach to Tactical Asset Allocation, advocating for a value approach in investing doubled by a momentum and trend following strategy. Welcome to our show, Meb Faber. How are the stock
Great
prices
to,
in LA?
great to be here. It's a beautiful morning. Looking out on the ocean as we speak. So all good.
Great. Please speak to us a little bit about the current investment environment and what should take into account a young investor considering the current valuations of the market.
Well, I'm going to reverse that question and answer the second part first, which is if you're a young investor, you probably don't have to worry about that much about valuations because you have such a long time horizon. And it sounds a bit backwards for most young investors, but the best thing that could happen for a young investor is that stock markets go down by 30, 50, 60, 80, 90%. And that seems a little backwards, but since stocks, which are essentially businesses, are long-term, when you buy a stock, you get a part ownership in a business with all of its cash flows and dividends and earnings forever, not just next year or 2 years. So it's a really long time horizon. And so the beauty of that is you end up with the ability to think in terms of decades rather than just weeks, months, quarters, years, which is what most people seem to want to think about today. That having been said, the best thing you can do as a young investor is the decision to invest in the first place. Now, of course, to invest, you have to save, which is always hard, particularly when you're young and don't have any money, like any of us ever did when we're young. But after that, we'll answer the first part of the question: is what do the markets look like? We always tell investors that normal stock market returns are extreme. There is really no normal when it comes to markets and investing. If you look at history is pretty wild already. It's like watching Game of Thrones or something. You say, man, this is a crazy plot line, and it's actually not that far from history, right? So in stock markets, you've had markets that have gone to zero, like Russia and China, based on governments. But even then, you've had markets like the U.S. that have declined by about 90% during the Great Depression. So the gyrations over the past year, while they feel a little bit crazy, are sort of totally in the realm of normalcy. We actually say this: people always expect around a 5 to 10% return in stock markets, maybe a little bit more right now, but almost never do stock markets actually return 5 to 10%. It's up 30, down 20, flat, all over the place. But long-winded answer to your partial question is that, markets, look pretty normal. A lot of them are in uptrends. Some are more expensive than others. Some are a lot cheaper than others. But in general, we seem to be coming out of, about 2 weeks away from a global spring break party. Maybe in Ibiza or somewhere over in Europe, right, where everyone's starting to get coming out of springtime and lockdowns. So fingers crossed that all the vaccine and everything prove to be working, and hopefully we turn the page and look forward to what's in the future.
Okay, but still the markets are pretty overvalued. And imagine you are a 30 years old young investor and have a lump sum of 100,000 euros to invest tomorrow. Which would be your strategy in this current environment? In this case, assuming your working capital, let's say it's zero, so you only have this lump sum to invest. And also, let's take another example of a young investor who has no savings, but has a lump sum, has an amount of 1,000 euros to invest monthly. So he actually dollar cost average this amount for the next 30 or 35 years. until he retires. So in these two scenarios, how would you construct the portfolio? Would be the same or more defensive in one place or than the other?
So there's two parts to that. You are correct in that I think that certain markets are expensive. The U.S. market is certainly one of those, but I'm of the belief that many markets around the world, most are reasonably priced, and some are screaming cheap. Not really to the point of your question. What to think about the 30-year-old who has some money and wants to put it to work? I can tell you the mathematical answer, and I can tell you the probably correct answer, which oddly enough is not the mathematical answer. The mathematical answer is almost always you need to put that money to work today. And the reason being is that historically, you earn money by investing it. And it doesn't just mean stocks. It can mean things like real assets, like real estate, commodity business. It can mean lending, like in types of fixed income or to corporations. And so what a lot of people don't like to do, though, however, is put it all in today, because then you have a time point, a flag you plant in the ground where, let's say you invest it all today and then the stock market goes down 50%. You're like, oh my God, I'm so stupid. Why did I do that? I should have waited. I knew better. So-and-so down the street told me I was crazy for doing that, and forever we'll have that regret. And as an investor, Bezos talks a lot about this. He lives his life with sort of regret minimization. So this concept of not psychologically wanting to impede your chances. So another reasonable idea is to simply what people call dollar cost average. So of that 100,000, maybe you put 10,000 in per month for the next year. And that way you get a blended average, or next 3 years, whatever it may be. But as far as the starting point on investments too, certainly what you want to avoid is the all-in mentality of putting all your chips on sort of one bet. A lot of investors like to do this, particularly when they're younger. They feel like they have to. They see a hot investment opportunity and they want to put all their money on it. And if you know anything from the racetrack or betting or sports gambling, playing blackjack, that's probably not the best idea. And so the starting point we always tell people would be, what if you were really rich and could buy every asset in the world that trades on an exchange? And the way that ends up looking like this global index average is about half stocks and about half bonds. And that's a pretty nice portfolio. I mean, John Bogle, who managed the multi-trillion-dollar Vanguard, has probably done more for investors than anyone on the planet in history. He had a similar portfolio. He said he put half in stocks and half in bonds. And he actually said that way he'd spend half the time worrying he had too much in stocks and half the time worrying he had too much in bonds. And of that global portfolio, about half is in the US because it happens to be the world's largest capital market, and about half is in the rest of the world, both bonds and stocks. And it turns out that's a pretty nice portfolio. It's extremely low cost, low turnover, low tax, and it gives you tens of thousands of securities around the world. After inflation, it'll probably do about 4% per year. So great. And so that's a great starting point, I think. And then people want to deviate from that. Certainly, there's a million different paths they could go down. But as a beginning spot, I think that's a great beginning.
What is your view on a short volatility strategy from a value investor's perspective? Would you prefer a strategic asset allocation or buying more when the market goes down?
All right, we're getting more complicated already. I like it. Okay, so in general, my personality is sort of schizophrenic. It's split into a few different mindsets. One is I am a value investor. Another way of saying that is I'm a cheap bastard. On the flip side, I'm also a momentum and trend follower. And many people just assume those two are in conflict, and really they're not. And at their core, actually, my ideal investment is when those two overlap. So something really cheap that happens to be going up, which, by the way, seems to be what we see right now in the U.S. with the value stocks that have been going straight up this year, really since last summer. So as you think about position sizing and how to invest in something, I think you need to have your rules. And we didn't really talk much about this, but most investors, one of the challenges they have is they are subjective and they don't really have a plan. So we often ask polls and say, investors, do you have a written investing plan? And very rarely do they. Almost never have they have something where they've written it down and shared it with their partner or children or parents or whatnot. And it's more of just like, I'm going to wing it, which is kind of crazy if you think about it. The single biggest determinant of your financial success and freedom and wealth in life, almost everything put together, is often just a cobbled together guesstimate or idea. And so why this ties back to your question is that, let's say you own a stock, could be anything. Let's call it Tesla, and it starts to go down. Well, if you don't have a plan, the history of stocks, that anything can happen. Any company could go to zero. Any company could go up 10, 100x over time. And obviously you want to put your odds in your favor, but almost every great trader in history will tell you they have tens, hundreds of times where they made trades and it didn't work out the way they thought it would, right? That the future is uncertain. So you may have done the best research on a stock and then turned out either to be wrong or there's just something you didn't foresee. So the challenge of something like a martingale, where you're investing more as it goes down, is challenging, and so in your mind, if you have the ability to say, and I actually wrote about this with a particular industry last year or 2 years ago, I said my initial position is going to be tiny. Think like 1% or 0.1% of your entire portfolio. And I said, there's a good chance it'll go down by 50%. And if it does, I'll double that position. And if it goes down by 50% again, I'll double it again. And but the problem with that is if you didn't have the sort of plan ahead of time, and as things go down and you keep doubling it, well, pretty soon it's 10, 20, 50% of your portfolio, and then it could potentially go to zero. So in general, I don't love short volatility strategies, but as long as you have parameters on how to think about them, I think they're probably okay.
By the way, why aren't you a supporter of a long short market neutral strategy where you also short expensive stocks?
I don't know why necessarily that you think I'm not a supporter of it. We actually manage a fund that can flip between totally long to 25, 50, 75, 100% short. So it can be all the way up to market neutral. It's currently 50% hedged because it hedges based on what the market's doing. So if half of it's based on valuation and half of it's based on trend. So currently the U.S. stock market, this is a U.S. focused fund. We run lots of international funds, but the U.S. fund is half hedged because the market's expensive, but it's going up. As far as shorting expensive stocks, I think it's a great strategy. You can find me on Twitter. I said short sellers are a national treasure because of the work they do. It's hard. It's thankless. They uncover lots of frauds that go on, and they're like the policemen of the stock market. The challenge is that it's fraught with danger. Shortings. If you buy a stock at $100, the most you can lose is $100. So the flip side on the short is that you short something at 100 and it goes 2, 3, 4, 500. Well, you lost a lot more than your initial $100. So it's hard. One. Two is that most individuals probably shouldn't be doing it because it is fighting a rising tide. Over time markets go up. And so you already are kind of running into the wind. That having been said, it's great strategy. I mean, go back 100 years, the time of the original hedge funds, that was the idea where you would pair a long position with a short position and say, look, I'm going to make money regardless of which way the market goes, just based on my stock picking ability. And it's certainly possible. The way we historically have approached the shorts is that we use the indices, so we'll short the S&P 500 instead of, say, just individual stocks. But I'm totally on board with people doing it. It's hard for someone like us to launch that strategy because you need the capacity to be managing in the hundreds of millions, if not billions, with it, and shorting at that size is very difficult. But we certainly encourage people to learn about shorting. I have a podcast publishing in an hour that has one of the history's greatest short sellers on, Tom Barton. We had him a few years ago on the podcast, and he tells lots of fun stories about shorting frauds in the 1980s and 90s. And then he talks about things today like Tesla and GameStop for fun and why he wouldn't be short those. Anyway, he came back on the podcast for a second show today. By the time this published, it'll be out. But so I'm a huge fan of short sellers. It's just hard. Like many things, it's like the old Buffett quote. It's like the too hard pile. And for most investors, they don't need to do it. But certainly, it's, if you're good at it. All my good friend short sellers are a little bit screwy. They got to screw loose somewhere, and I say that in a loving, good way. And there's some great books on short selling, but it's hard. And by the way, they're totally an endangered species. There's, after a 10-year romping, stomping bull market in the U.S., there's very few left. It feels like.
A lot of people ask me this, and I will also ask you. Can you disclose your current asset allocation in this market environment?
Sure. I'm actually, I think, a rarity that we'll talk about this, particularly for public asset managers and people that tend to spend a little time on TV and online. There's a very sad stat that it's something like over half of mutual fund managers, portfolio managers, have nothing invested in their own fund. And if you think about that, that's a little bit crazy. To me, I think I want partners in life that have skin in the game or have common incentives and interests as mine. So we started disclosing a long time ago, and we updated it last year. I think we're about due for an update. Nothing much has changed in the past year. I wrote a book, one of our 5 books I've written, called Global Asset Allocation. It's free to download online if you go to my blog or Cambria Investments, and it looks at famous asset allocations in history and how they've done, who the kind of horse race winner was. One allocation that's 2,000 years old is the old Talmud, which says, let every man invest a third in business, a third in land, and a third keep in reserve. And I actually think that's pretty good investment advice. And you could do the modern equivalent, which would be a third in global stocks, a third in global bonds, a third in real assets. And I have something similar. So if you zoom way out, my real asset category, my family is comes from a farming background, so traditional row crops in the Midwest of the United States, like wheat and corn. So we still do some farming, which for the early part of the 2000s was one of the world's best at asset classes. For the later part of the 2010s was one of the world's not worst, but just kind of went nowhere. But ag prices seem to be picking up again here in 2021. So we'll see. And then, I put all my public assets into our public funds. And so and there's a strategy which we could certainly talk about that's called Trinity, which is the majority of my allocation. I have bits and pieces in some other areas. We have a blog post if listeners want to Google it, called How I Invest My Money, something like that details it actually quite a bit more specifically. And on the investment side, I've invested in probably 200, almost 250 startups over the past 6-7 years. So to me, that is a way of accomplishing a few different goals. The first is education. Every day getting to read about thousands of cool companies that are trying to change the world in all sorts of different industries. Being able to check a behavioral bias box. So winding back to the very beginning of the conversation, we talked about what should a young person do? And in most cases, almost always, it's the investment should follow what we call almost like a coffee can portfolio, where you buy something, you put it in this coffee can, put it behind the cabinet and leave it there for 10, 20, 30 years. And that's what it takes for a lot of these investments to compound. So if you look at, there's a couple good investment books. One is called 100 to 1 in the stock market. The other is called 100 Baggers. And they talk about investments where you make 100 times your money, not 100%, but 100 times. So that 100,000 would become $10 million. And the problem for most people is that they sell their winning investments way too soon. So you invest something, 100,000 into something, and it turns into 150, 200,000. You're absolutely elated, so happy. Probably going to sell it. I mean, just ecstatic. Think about all the quick wealth people in the crypto world have experienced, and in a lot of other areas of investments too. But if you look at some of the history's best stocks that have gone on to compound by 20% per year for 10 years, it takes a while. It usually doesn't just take a year or two. It takes a decade or two. Berkshire Hathaway, Monster Beverage, Amazon, Apple. So you got to give a long-term perspective. And for me, I have all the behavioral issues. I'm overconfident. I'll take on too much risk. And so the private investing checks a box for me, which is I can't sell it. If you invest in a private company, on something like an AngelList or WeFunder, the ability to look at your stocks all day long on a stock account is really tempting. So the ability to say, I can't sell this even if I wanted to, it's either going to go out of business or it's going to get merged or it'll become public at some point, I think is a pretty useful construct. Now, you can get on the other side of that and get in trouble by not having any liquidity. So if you need that money to buy a house, pay for college, raise some children, get married, whatever it may be, that's not a good bucket. So let's see. Those are the main ones. Am I forgetting anything? Probably. We have some rounding errors. I got some old comic books from when I was a kid that are probably worth $10. I don't know. But other than that, those are the main moving parts.
Okay. In your most recent interview with legendary investor Jeremy Grantham, he was mentioning that investors should use their relative bets to overweight emerging markets and specifically value stocks, and also avoid US growth stocks. Another feature in investing is avoiding stocks, so not only allocating capital. On the other side, Mr. Larry Sudrow considers that in an efficient market, all asset classes have the same risk-adjusted return. Do you think that it is possible to get a better risk-adjusted return by investing in cheaper, undervalued regions or higher expected returns, albeit higher volatility?
So I think there's the two approaches that I really lean on that we mentioned are value and trend. In value, both of those go back 100 years. Value goes back to the time of Ben Graham, who was talking about it, and certainly earlier. And trend back to the time of Charles Dow, who started the Wall Street Journal, among other businesses. Again, certainly went back before him as well, but both being known for the work. And on the value side, there's no question in my mind that tilting towards value adds returns over time. Now, it may be only like 2% per year. So if your broad investment category is going to do 8%, maybe you'll make 10. It's not going to go from 8 to, I think, 30 or 40 or 50 over time, as a lot of people would expect, but it does add value and it's worth doing. Now, if you get more concentrated and weird, certainly can you attract the higher returns? Absolutely. And then on the flip side, momentum and trend. And the way a lot of the indices are built, momentum and trend, in many ways, give you the ability to, if you think of the stock market in general, of all the stocks, a very few percentage have the ability to make up all the return. So it's something like 5% of stocks generate essentially all the return in the stock market because you own these massive winners, the McDonald's, the Walmarts, again, Apple, Amazon's, Google. And so having the trend and momentum side guarantees you to own those over time. And that's what market cap weighted indexes are. So I like both. Value to me is the most obvious way to think about investing. If you think about it, Why, in what other area of life is anyone not using value? You don't walk down your street and say, I want to buy this house, but I don't really care what the price is. Or I'm going to buy this car. Price is irrelevant. Most people don't say that, right? But when it comes to stock market, they do, which is crazy to me. And if you look at the US, if you look at global valuations currently, we like using the 10-year price earnings ratio, so the Shiller-Cape ratio. And historically, over time, that's been around 17 on average for countries. Modern low inflation, let's call it maybe 22. But many countries have been as low as 5, and often they'll even get as high as the 40s. And the highest the US has ever been, for perspective, was 45 in the internet bubble in 1999. And it's trading right now around value for, I think, around 34, 35. So certainly high, very high relative to history. The good news is the rest of the world, ex-US, is around that normal average value, around 22. Emerging markets are down around 15, so significantly cheaper. But really, any indice is just a group of stocks. And so you could certainly say, well, what is emerging value, or what is foreign developed value? And so in other areas, you have pockets that are actually quite a bit cheaper than the actual indices themselves. And so if you look at the 12 cheapest stock markets in the world out of the 45 developed and emerging, you get to a price earnings ratio of around 12. So pretty darn cheap. Even like countries that are long established capital markets that have been around forever, like the UK. UK is trading at, I think, 14. So well less than half of the US valuations. And so having that value tilt, to me, is essential, certainly if you want to survive. The biggest problem with the expensive markets like the US, the greatest example we ever have was Japan in the 1980s, that hit a price earnings ratio of almost 100, which is totally bananas. They went 30 years with no returns afterwards. So you can have these big fat losses after these bubble type of markets, and Grantham certainly believes that we are in that sort of environment currently. So tilting away from those kind of companies and stocks makes a lot of sense. Now, that having been said, I remember, again, talking about to the indice, there's often stocks within a stock market that are totally fine. If you go back to the 1999 bubble, we certainly had the case where there was plenty of stocks that didn't even have a bear market in 2000, 2003. It was really concentrated in the large cap growthy names, the tech names, like we have again today. So it just each market is different, but certainly there's some areas of opportunity that are just fine now. If you look at things like energy, it's crazy because it's only about 3% of the S&P 500, and at one point it was as high as 30. And energy is not going away overnight, certainly, but it's often when things get really expensive, there's other things hiding beneath the surface that are just fine.
Yeah, I think one of the biggest problems investors have with these cheap countries is that they are very volatile, and also in terms of currencies, the ETFs available have higher TER than the overall market, and also you can have value traps. If you only invest in a basket of cheaper countries based on Captain indicator, doesn't skewness affect your returns? And also, what reliable sources of data do you use to determine which are the current CAPE values for individual countries?
Yeah, so I'll answer the last one first. We have a pinned tweet that you'll have to dig up that is something along the lines of, we have an article called The Case for Global Investing that runs through about 5 or 6 great research pieces and talks about why every investor should invest globally. Doesn't matter if you're in the US or Romania or Australia or Japan or wherever. The vast majority of investors invest most of their money into their own country's stock market. And that is really foolish. And the reason being is that we live in a world of opportunity, and being needlessly concentrated in something that feels warm and fuzzy and cozy nearby ends up giving you extremely volatile and concentrated exposure. And sometimes that works out. Most of the time it doesn't. If you talk to anyone in Greece, Brazil, Russia, China, India, on and on and on, UK, Japan, over the past 10 years, that's been a very suboptimal way to invest. So as far as valuations, we love talking about CAPE ratio. Let me be clear that almost any valuation metric should say the same thing when markets are extremes. So we have a tweet thread currently that is talking about a lot of the bubbly behavior in the US and has a bunch of charts. But it's not just CAPE ratio. In fact, most of the valuation metrics are worse than the CAPE ratio. But using something as simple as dividends is a pretty good proxy as well for value. As far as resources, so we have a pinned tweet that lists about 5 or 6 or 7 free and paid resources to find things like this. There's things like Barclays publishes some, Star Capital based out of Germany publishes some for free. Other sites have it behind a firewall or paid. But there's plenty of places, if you do a little Googling, you can find a lot of the valuation metrics online.
Yeah, Star Capital hasn't updated lately for the past.
Uh-oh. Okay, well, the funny thing about valuations too is, we've been publishing it on our idea farm for, 5-7 years. And investors always love emailing, asking me, say, hey, Meb, can you update this monthly? To which I respond, I was like, I don't even need to update this yearly. These value sort of episodes move at a pretty glacial pace. Granted, there's usually a crisis going on somewhere. So usually the way is that countries get cheap is not really the earnings. It's usually that the price goes down 40, 60, 80, 90%. And so you really have to only update these like once a year, because you want to be, the way value works is you want to be in the right galaxy, where if you have a price earnings ratio of 7, is that estimate, is that ratio exact? Does it matter if it's 7 or 9 or 5? Not really. The question really is it 7 or is it 35 where the US is today? So I think as long as you get the kind of the main moving pieces, and even then after that, you can kind of just watch markets and not be surprised by what the results are, and look around and something goes down 70% and say, well, that probably got pretty cheap over the last year. It's really the P that's the big mover in the equation.
Mm-hmm. We know that you described an ETF that identifies the cheapest stock markets in the world using a composite of cyclically adjusted price ratios. CambriaFunds.com, global value. Unfortunately, we do not have access to this ETF since we are European retail investors. Therefore, do you think that a retail investor should implement such a portfolio on its own? I think about the complexity of rebalancing, transaction costs, maybe lack of momentum, and so on and so forth.
Let me make a couple comments. One is that, that we like to talk about like big muscle movements, like what gets you most of the way there with the least amount of effort. And most investors' portfolios we see from what they have currently are so far away from even being in the right area that anything will benefit. So almost always they're hopelessly concentrated in their own country. So just moving to the global average, particularly in the US, if you're domiciled here, not for most of your listeners, all of a sudden takes you to a much more broad global portfolio. And that right there is already a good step. So that's first step. Second step would be, okay, well, let's tilt towards value. So there's plenty of funds that will have value approaches, whether they're quantitative or subjective. We prefer quants, of course, because that's what we are. But really, it's more of a question of cost. We have yet to really talk about fees and taxes, but when you look at the biggest determinants of portfolio performance, the first one I think is the choice to save and invest in the first place. So the younger, the better. Second is getting it invested in the correct investments, broadly speaking. So some stocks, bonds, and global real assets. But one of the most important is also what you pay. And so many countries around the world are still really expensive funds. And the simple advice is to try to pay as little as possible and certainly if you get below 1% or below 0.5% or below 1/4%, it gets better and better. And the lower you get, the less it matters the exact, decimal point, three to the right of the decimal. But it has a significant impact. Certainly the people out there that don't know what they're paying, that might be paying 1.5 to 3%. That's absolutely just makes everything else we've talked about totally irrelevant, because you're just paying it all to your broker. Now, are there some investment funds that are worth the higher fees? Sure, absolutely. It just sets a much higher bar. If you think of the pole vault or high jump, right? It means it's just a lot higher. You have to be a Olympic quality athlete to get over it. So I think there's stages of usefulness, getting global, tilting towards value. And again, you don't even have to update it every year. You can update a value portfolio every 3 years and still end up in the same place, most likely. So that'd be my advice. Be kind of sloth-like, tortoise-like in your behavior, and probably spend more time paying attention to fees and taxes than just about anything else.
From a top-down or bottom-up perspective, would you choose perhaps a smart beta multi-factor ETF for, let's say, emerging markets or these cheaper areas to be simple to implement for retail investors in the absence of a global value portfolio?
Yeah, I mean, it's always important to look under the hood in what you're investing in and to understand it. I think a lot of investments are end up being pretty similar. A good example is, you mentioned our global value fund. That takes a top-down approach. It picks the 12 cheapest countries out of 45 in the world, rebalances once a year. Pretty simple. We have other strategies. We have a developed markets and emerging market. Both these are shareholder yield, but pretty close to the global value. And they ignore countries, but they just look at the entire stock market as a whole around the world. And go bottom up. And you often end up with totally different allocations across countries and sectors. But in many cases, the return stream looks similar, because the question is, did you invest in value in the first place? Right. And so compared to a market cap weighted average like the S&P, similar, that overweights a ton of expensive stocks, either of the value approaches should do fine relative to that. So most of our funds, even the ones that do top down, will also do bottom up. Just understand that every investment decision you make will give you a specific intentional or not bias. So if you go top down, that'll probably tilt you more towards smaller countries, whereas bottom up, just because Japan may have 3,000 stocks, but Czech Republic has 20, you end up with a different exposure. Either one, I think, is fine. You just need to be thoughtful and aware of it.
Mm-hmm. We studied the Trinity Portfolio that you described in your podcast. Implementing the trend following approach is very tempting, since we are playing defense against black swans. We were also amazed by the findings mentioned in your paper named A Quantitative Approach to Tactical Asset Allocation, in terms of reduction of drawdown and standard deviation, and also in terms of Sharpe ratio. Tell us a little bit about this strategy and whether we can implement it mainly with different sub-asset classes of equities, for instance, in a 75-25 portfolio.
Yeah, so trend, is a totally different animal we haven't talked a lot about today. And the simple origins of trend is trying to be invested in markets as they go up and not as they go down, right? Sounds simple, sounds seductive. Many people want to sort of co-opt that message and actually say, I want to pick the tops and pick the bottoms, right? I want to sell in December 1999 and not buy again until 2003. That's a tall request that is going to be fraught with failure, most likely. But what trend following says, it understands a very important insight, which is, as you mentioned earlier, markets are volatile, but they also go through regular, painful, and long drawdowns. And so we mentioned the US has seen 90% before, but even in the past 2 decades has seen 50% declines. And most foreign markets have seen similar or worse. Think of somewhere like Greece or Brazil, which has been worse. And the problem with the big declines is it ends up being catastrophic for people's portfolios, but also for their psyche, their emotional state when you lose that much money. And frankly, it really starts to get worse after, say, 20%. People lose 10%, they start to get a little grumpy. 20% is really, to me, the inflection point. And every 10% after that, it gets exponentially worse. It's like the earthquake Richter laws or power laws, where it gets exponentially worse the further it goes down. So trying to avoid those huge losses, I think, is really important. I mean, another good example is the compounding, challenge of you have a kink where after losing a certain amount, I think it's around 15-20%, it takes a lot more to get out of that hole. So as an example, you lose 50%, it's not 50% to get back to even, it's 100%. And so 75% is 300%. So avoiding these big, huge, fat losses is pretty important. Sounds good, of course, right? If you can help it. But the challenge is, how do you go about it? And so trend is something, again, that's been around for over 100 years. And at its core, I published this very first paper of mine back before the last financial crisis. Let's call it 2006-07. And it simply said, let's use the most famous trend following indicator. We'll call it the 200-day moving average. It's a way of sort of trying to find the signal, separate it from the noise. And if price is above, you'll stay invested in a market. And if it goes below, you get out. That's it. We applied it on a monthly basis. I said, I'm even lazier than that. So let's do it on a monthly basis. And we'll look at it once a month. It takes 30 seconds. And the historical results, what we found was that, this wasn't surprising, but was that you get similar returns buy and hold, but with lower volatility and lower big losses, because you have the ability to move to cash and bonds when the portfolio, when the markets are declining. And so you can overlay that across any market, and you end up with a portfolio that on average has been lower volatility and lower drawdown. And the out of sample returns since publication for the past 13 years have done what they are expected to have done. But like any investing approach, it's hard. If you look at buy and hold, why is buy and hold hard? Buy and hold is hard because you don't do anything. And so when you have investments that go down 10, 20, 40, 60, 80%, it's really difficult just to sit there and sit on your hands, because most people, that's a very painful experience. Excuse me. Trend following is hard because you often look different than everyone else, and that's good and bad. So when everyone else is making a ton of money, in many cases, you may be not making as much money, and there's nothing worse than not making as much money as your neighbor. And then second, in sort of sideways markets, you may have a number of losing trades in a row. So as markets go up and down, you get whipsawed in and out. And a lot of people don't like a low batting average. They like higher certainty. They want 90% of their trades to be winners, when in reality, many trend following systems, maybe only half, could be even as low as a third, do well, but the big winners make up for the big losers. And so it's also hard. And so going back to the early discussion on, well, how do I invest my money? I put most of my public assets into the strategy called Trinity. And Trinity is half buy and hold. So it's a global allocation, like we talked about, stocks, bonds, real assets. We tilt towards value and momentum, low cost investing, all in one. And the other half is in trend following. And there's a lot of different flavors of trend following, just like there's a lot of different flavors of value investing. But in my mind, that's my desert island strategy, where if everything goes to, it hits the fan and things, picture the pandemic, but not getting better, or Great Depression or anything, it has the ability to move to the side and say, okay, we're going to sit this one out. And to me, it's such a thoughtful investing approach, because half the time you say, thank God for buy and hold. Post-pandemic starting in March, so happy I had buy and hold because things have ripped right back up. The quarter before that, say, oh my gosh, thank goodness for trend following, because I wanted the ability to protect my assets in case markets really did go down significantly worse than they did. And some cases they went down a lot. I mean, I think small cap value was down by half in Q1 last year, but it also applies to commodities and other areas. So, for me, it works. I think it's an approach that I like. Others may not agree, but that's it at its core.
What do you consider being the biggest disadvantage of a trend following strategy? In other words, a time series momentum based on a simple moving average 200. I ask this because it seems to be the holy grail of investing. As you said, we achieve equity-like returns with bond-like volatility and drawdowns. And we don't have managed future CTFs here in Europe, so perhaps we should implement this manually.
Yeah, I mean, look, there's the struggle, of course, is that with any investing approach, the biggest disconnect for people is their expectations and time horizon. And we tell people almost always that everyone thinks in terms of weeks, quarters, months, even years. When someone allocates to an investment, it could be an asset class, a sector, a country, a strategy like value or trend. They may give it a couple years, and if it underperforms, they'll sell it. But in reality, the correct time frame is probably a minimum of 10 years, and more honestly, closer to 20. And people say, that's crazy. I'll never give someone that long. That's an entire lifetime. And but the sad reality is that's the truth. That's what it takes. And I'll give you an example. There's no more ironclad belief in all financial markets than stocks outperform bonds over time. Everyone I know believes that. I don't know a single person that doesn't believe that. But what most people assume is that happens over the course of a year or two. And this past year in the US, and this is the same everywhere else, but there was a period where US stocks had the same performance as long-term bonds for not a couple years, not 5 years, not 10 years, 40 years. So 40 years ago, had you just invested in long-term bonds, you'd have the same returns as stocks. Now, this is sort of during the pandemic, and stocks have obviously gone up since. But my point being is that this applies to active managers, this applies to trend following. And so a lot of these strategies can go through painful periods of underperformance. Think about value hasn't done particularly well, 2020 and prior 5-10 years. Trend following has had mixed results. That's both of those seem to be changing in the past year, of course, but it just goes to show that every asset and strategy has its day in the sun. Right now, it might be non-fungible tokens and crypto. Tomorrow, it may be GameStop. The next day, it may be agriculture, and the next day, it may be bonds. Who knows? But the point is that anytime you allocate to a strategy or manager or style like trend or value, you need to have a fairly long-term horizon.
Yeah, in your Trinity portfolios, a significant amount was allocated to bonds. For someone living in Europe who has a rather conservative risk profile, how do you recommend investing the safe part of their portfolio given US Treasury offer low yields and high currency risks?
So we did a 4-part series last year on the blog. It's called the Get Rich Portfolio, the Stay Rich Portfolio, how I invest my money, and then investing in a time of coronavirus. And each part talked about some different ideas. The second part of the series was called the Stay Rich Portfolio. And we actually had a comment where we said, look, it's going to surprise most people, but you assume the safe asset is bonds or cash. But in reality, the biggest risk to bonds is not sort of nominal returns, it's the eroding effects of inflation. And so you can look at markets in history. And my favorite read just came out. You can post a link to this, the Global Investment Returns Yearbook. It's free to read from Credit Suisse. But it looks at things like bonds over the past 100 years. And even in the US, bonds lost about half based on inflation at one point, and say, well, that doesn't sound like a very safe investment. And so, yes, do we think bonds have a natural role in a portfolio? We do, but we also demonstrate in this article that in reality, the safest portfolios, you actually need to invest, whether it's a third or a half of your portfolio in traditional assets like stocks and real assets like real estate and commodities ends up being safer than a portfolio of just bonds. And the reason being is that you need that growth to keep up with the risk of inflation. And in some places, and sometimes in history, inflation has been far worse, than it is currently. A lot of Europe has been dealing with the opposite problem. So this kind of goes back to the comments earlier about every asset has its time. Like, you want a portfolio that's going to be robust to inflation as well as deflation. What if gold goes to 10,000? What if it goes to 200? What if stocks go up 10% a year for the next decade? What if they go down 80%? What if bonds go to minus 3%? What if they go to 10%? You have to at least consider all the possible outcomes. And that's where people get into the biggest trouble, is they have a worldview. And this is like relationships, with your partner, your children, with your parents, your relatives. Expectations play such a large role. And when do the biggest problems occur at the family holidays? It's when expectations don't meet reality. Or think to your partner, boyfriend, girlfriend, wife, husband, children. Someone has expectations and they're not met. That's when people get upset. Same thing with investments. I mean, recent research came out saying U.S. investors expect 15% per year, which is never going to happen. Literally will never happen. Average returns historically are about 5% after inflation for a portfolio. Stocks get up to about 6.5%. Of course, you add on inflation, you get up to that 8 or 10% number. But so anyway, that's the challenge. I think is the biggest is trying to correlate expectations to reality, which is hard.
Yeah, I think that regarding the safety of bonds for an early retiree, William Bengen has written an interesting paper on the safe withdrawal rate of 4%. And he demonstrated that you need at least 50% in stocks, or even up to 75% if you want to live until, let's say, 90 years. Very hard to do it with a very conservative allocation, so only 30% in equities.
Yeah.
If we discuss about this, how should an early retiree allocate his capital, assuming he's 50 years old, his life expectancy is 90, if he wants to have a 4% withdrawal rate, given that the capital market line right now shows that both the risk-free assets and the risk premiums are much lower for the coming future?
First of all, I'd say good job retiring at 50. Man, I'm ready. I'm not too far away from that. I that sounds great to me. Actually, I hope I never retire. I love working and being engaged. But I'll take your example for, I think, probably your intention, which is someone who wants to live on this passive income and position it in a way that is robust and anti-fragile, I guess would be a good description. It's hard. The future has sort of it's like a Marvel movie, endless possibilities, and you have to mentally prepare. This is what so many investors struggle with. They want to adhere to one worldview. They're a gold bug, or they are deflationists, or they hate the Fed, whatever it may be. But trying to prepare for every possible outcome, I think, is important. And so, I mean, I know it sounds tongue in cheek, but going back to that Talmud portfolio, it's such a beautiful portfolio because it has something for everything. And the reality is, if you go to the Global Asset Allocation book, most portfolios do just fine as long as you have some of the main ingredients. And I often talk about my mom is a great cook, and she does it by feel. And so the example I always give is chocolate chip cookies. You make chocolate chip cookies, doesn't matter exactly how much butter and sugar and chocolate chips you have, as long as you have some of each. They're going to turn out great and everyone's going to be happy. What the problem is if you totally omit one of them, you end up with something that's probably not ideal. And so in this example is the same thing with stocks, global bonds, global real assets at a low cost. Like, that's the starting point. If you have all that, you're probably going to do just fine. Getting to the specifics after that is sort of the final frosting on the cake, is probably less important. But I would certainly do that starting point. And then you heard my opinions. I like value. I like trend. I like concentrated and weird. Certainly, most people aren't comfortable with as concentrated portfolios as I have. But I think, to me, you have to keep it invested. Otherwise, if you're fixed income only, you run the risk of that sort of high inflation world, which, to be honest, seems like an increasing risk as a lot of the stimulus and governments continue to go down that road.
Yeah. Do you recommend another inflation hedge in our portfolio besides equities?
Well, you guys want some farmland in Kansas? I'll sell it to you. Look, the equities are great. There's no question they're great. I don't think they're great at a price earnings ratio of 35 like they are in the US, but they're great elsewhere. And then there's plenty of things like real estate. I mean, most investors around the world, their number one exposure is their house or their real estate. So that already has a natural inflation hedge. And then there's a lot of other sort of investments that kind of are in the same ballpark, like tips, and other things. But in that broad category, I think they're all probably useful.
Do you have any particular views on which countries you see as being undervalued right now? And would you keep this valuation perspective when you also retire, given that these areas usually have higher standard deviation? So they decrease the withdrawal rate.
It's always funny when you talk about risk, because when I travel the world and I listen to people in the US explain why they invest most of their money in the US, and they'll say things like stable geopolitics, and then I'll travel around the world and say, have you been paying attention? None of this seems remotely stable, calm to me, although maybe it's returning that way. Who knows? We'll see. You never know what markets are going to be volatile in the future. It's easier to look at, yes, have they been volatile in the past? And to be clear, when we're talking about volatility and standard deviation, the only one we care about is down volatility and standard deviation. Nobody cares about markets that are extremely volatile to the upside and making a ton of money. But I don't know that history is a blueprint for the future. If you were to go back to 1899, the US wasn't the largest stock market in the world. UK was, and UK is now what, like 4% of the total? There were other countries that you probably would have put equally large of a bet on in 1899. Argentina, which is now, a rounding error on the global market cap stage. So what countries will become ascendant? We'll find out. As far as valuations today, Eastern Europe is a big one for us that we're allocated to. We got a mixture of Russia, Brazil, Singapore. What else is in there? A lot of Europe has lagged. I mean, if you look at the valuation spreads, we did an article called "The Biggest Valuation Spread in 40 Years," which is U.S. versus the rest of the world. And that's as high as it's ever been. 40 years ago, the U.S. was cheap and the rest of the world was expensive. So you have somewhat of a flip that has gone on. I would expect that to reverse over the next 10 years.
Uh-huh. If you were to invest in only one instrument for the next 10 years, what would you choose and why?
So it's one of two things, okay? And I'm like everything, I don't really answer questions directly. So I apologize. If you say desert island, I have to prepare for anything to happen. It's this kind of global momentum and trend that has the ability to invest in anything that's going up, but it'll exit to the safety of cash as it's going down. We have a fund that does that. It can be highly concentrated, but that's sort of like an end of the world portfolio for me. On the flip side, if you were to say, Meb, what's going to be the highest returning? Your goal is just to get highest returns. I would invest in that global deep value strategy. So the 12 cheapest countries in the world, which puts you in places like Russia, Czech Republic, Poland, on and on. I think that is poised for serious outperformance. Value has not helped. It's done very poorly over the past 5-10 years. So I think it's due for a huge rebound over the next 10 years. So I'm very bullish on markets outside the US, particularly the really cheap countries and really cheap stocks.
Thank you very much, Meb Faber, for discussing with us today. Tell us a little bit where we can find more about you, your work, and your research.
It was a blast. Hopefully, when the world reopens, we can do this in person. I was supposed to be in Europe a few times in the past year, so fingers crossed soon. Lots of places, anywhere with my name. So the blog is mebfaber.com, ditto for Twitter, and the podcast. My day job is managing Cambria. We have about $1 billion in assets across 12 funds. So that's Cambria Funds or CambriaInvestments.com. Yeah, those are the best spots. And you can download all our books for free. If you go to one of those websites, check them out and let me know what you think.
Great. Thank you very much for your time. Have a nice day, and Lord, have mercy. Bye-bye.
Cheers. Bye.